Hey everyone, welcome back to Corporate Decoder. Today, Lisata Therapeutics Incorporated just filed an 8, and I am seeing a deal blow up that could change everything. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company's big merger is officially off, and now they are back to the drawing board, potentially looking at drastic changes. So what happened? On the 24th of July, Lisata Therapeutics Incorporated announced they are terminating an agreement they had to be bought. Remember that deal with Kuva Labs Incorporated? That is now officially off the table. This merger was supposed to be a pretty big deal. Kuva Labs, through a company called Kuva Acquisition Corp, agreed to buy all of Lisata's shares. The price was set at $4 per S-share, plus a chance to get up to $3 more through something called a contingent value right, or CVR. These CVRs are basically promises of future payments if certain milestones are met. A tender offer was launched where shareholders could sell their shares. After that, a merger was supposed to happen to buy out any remaining shares. This whole deal was first announced back in March. We have seen several updates about it since then, with tender offer extensions and progress reports. Everything seemed to be moving forward, even with financing being a question mark. But here is where it all fell apart. The buyer, Kuva Labs, failed to actually buy the shares that were offered. They apparently could not secure the necessary financing to complete the deal. So, as of the 24th of July, Lisata Therapeutics has officially pulled the plug. The company stated that the shares tendered in the offer will be returned to their owners. Now, when a deal like this breaks, there are usually consequences. In this case, Kuva Labs is actually obligated to pay Lisata Therapeutics a termination fee of $2 million. However, Lisata also points out that they are reserving all their rights to seek further legal action, including damages for what they call willful breach. This basically means they believe the buyer intentionally caused the deal to fail. But here is a big dose of reality. Lisata says there is no guarantee they will be able to collect any damages even if they win a legal battle. They mention their own limited financial resources to fund litigation and the possibility that the buyer might not have the assets to pay any judgment. This is a tough spot to be in, so the merger is dead and the $2 million termination fee might not be enough to cover the losses. What is next for Lisata Therapeutics? The company's board of directors is now planning to seriously evaluate all their options to try and get more value for their shareholders. This assessment will look at a wide range of possibilities. We are talking about things like a reverse merger, which is essentially combining with another company, other kinds of business combinations, selling off parts of the company's assets, or even shutting down the company altogether. They are exploring every avenue to try and make the best of this situation. Lisata is very clear though that there is no guarantee that exploring these alternatives will lead to any deals or successful transactions. They are not putting a timeline on this review and don't plan to provide updates unless a major decision is made. This makes sense given the circumstances. The failed merger is a significant setback. The market was expecting the deal to go through. And now that it has collapsed due to financing issues, the company's future is uncertain. Historically, a failed acquisition, especially one where financing is the culprit, can signal deeper financial problems for the company being acquired, or at least put them in a weaker negotiating position for future deals. Similar situations, like what happened with Bed Bath & Beyond before its eventual bankruptcy, show how a string of failed strategic moves can unravel a company. Lisata's market cap is currently around $15 million and they have a very small employee count, just 21. This makes their situation even more precarious, as they likely lack the internal resources to mount a lengthy legal battle or to restructure effectively without external help. The fact that the buyer couldn't secure financing for a deal that was priced at a premium could also mean that investors were already signaling concerns about Lisata's underlying value or future prospects, making it harder to attract new capital or buyers on favorable terms. My biggest concern is Lisata's limited financial resources. Pursuing legal action and exploring complex strategic alternatives requires significant capital, which they may not have. This could force them into unfavorable deals just to survive. The risk I'm watching is whether they can find a partner or a strategic path that genuinely enhances shareholder value, or if they will be forced into a liquidation or a highly dilutive transaction simply to stay afloat. This report is signed by David J. Mazzo, the President and Chief Executive Officer, on the 24th of July 2026. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If you found this analysis helpful, please like, subscribe, and join our Discord community.